Lynch was a portfolio manager for Magellan Fund at Fidelity Investments, and over the time he managed to achieve stellar returns for the fund. He ran this portfolio for 13 years, and when he finally decided to retire at only age of 46. What is worth noting is that when he took over, assets under management were about $18 million and grew that amount to over $13 billion. What's interesting is the fact that when he left Magellan, portfolio had about 1,000 individual stocks. If you watched previous videos about Terry Smith or Warren Buffett, you might have noticed that they run pretty concentrated portfolios. How many good ideas can you get? But Peter Lynch certainly didn't lack good ideas, as there was a saying that there was no stock that he didn't like. When he saw revitalization in certain industry, he sometimes didn't even try to predict the next winner. He would simply buy dozens of companies in that specific industry. Peter Lynch, similarly to other great capital allocators we covered, doesn't hesitate to share his knowledge. In fact, he's an author of 3 books that cover investing. First one is Learn to Earn, which might be considered entry-level guide to investing. And with his easy to understand language, pretty much anyone can pick this book as its first choice. I'm not sure it's that helpful for more advanced investors as it covers pretty basic stuff. But the next one is really full of nuggets of wisdom and concepts that I am sure will make a better investor out of you. This book is called One Up on Wall Street, and I'm sure you will benefit from it, no matter how advanced into investing you are. First lesson is to know what you own, which sounds close to Buffett's circle of competence. Well, it might sound obvious, but it's not only that you understand what is the product or service sold by the company, but rather if you understand the economics and root causes that shape the industry. For example, you might understand how does a computer work, but do you understand factors that determine success in the industry? Some of Lynch winners are stocks like Philip Morris, Fannie Mae, Ford, or Volvo. So we have examples of cigarettes, financials, and cars. No Microsoft, Apple, IBM inside. This next lesson I find particularly interesting. Lynch recommends classifying your stocks into categories. And the first one is fast growers, as the name suggests, are the companies that grow their earnings rapidly. Usually it's more than 15% yearly. Those don't have to be hot tech companies with groundbreaking patents promising to disrupt the world we live in. Those might be simple products that customers seem to love and are willing to pay for. Lynch advises look for small companies that are already profitable and have proven that their concept can be replicated. But he also warns be suspicious of companies with growth rates of 50 to 100% a year. The funny example that author gives is Anheuser-Busch, and why I find it funny is because company was classified as fast grower by Lynch, and it has been struggling pretty recently, and it was struggling a lot. But he says that companies go through different categories and they don't have to stay in the same category. And we have a perfect example. The next category are stalwarts. Those still grow, but this is the growth is not as fast growers. It's somewhere in range of 5 to 15% per year. But we need to note that those would be rather bigger companies that simply cannot grow that fast. Examples of those are well-known brands such as Coca-Cola, Procter& Gamble, or Colgate. We talked about 80s here, so Buffett's purchase of Coca-Cola would be classified as a purchase of stalwart in Lynch's classification. It's also worth noting that company doesn't have to necessarily increase number of units sold, open hundreds of new shops to grow. As for example, Philip Morris sells cigarettes, and back then they didn't innovate with new generation heated tobacco. They simply had great brands that smokers knew and enjoyed. They could focus on cutting costs and improving their margins to enjoy good growth. Lynch recommends keeping few stalwarts in your portfolio for recession, as they tend to perform better during such periods. And I would also note that Lynch, as investment manager, had to protect his portfolio in some manner from huge downside, as investors would immediately start withdrawing their funds. Third category is slow growers. If company grows EPS for less than 5% annually, it's a slow grower. Those are big companies which have lost their way for dynamic growth. Those are not bought for growth, but rather for stable dividend checks. Sooner or later, every growing industry that was considered to be fast grower might slow down and belong to this category. This happened, for example, to electric utilities. In the 1950s and 60s, as people were buying large refrigerators or air conditioners and their electric bills raised quickly, electric utilities were considered high growth. But when costs of energy skyrocketed in the 1970s, people paid more attention to conserving energy and industry lost its fire. Keep that in mind before investing in the next hot industry, as they might share fate of electric utilities. That's similar with internet companies, where biggest providers such as AT&T and Verizon are struggling to grow. And the fourth category is turnarounds. Those are no growers, on the contrary. Those companies might have actually shrunk significantly, and Lynch calls them potential fatalities. Those companies once might have even belonged to fast growers, but some problems occurred, and now these once great stories are coming to an end. Usually, management doesn't just sit and wait patiently for the Titanic to fall. They rather implement some sort of a plan to save the ship. Offer gives the example of Lockheed, which in 1980 had quite profitable division of defense that earned 805 EPS, but its commercial deviation has lost 6.54 EPS. So in total, they earned 1.5 EPS. This was caused by L-1011 three-star passenger jet, which was losing against its competition, and losses were persistent. So management decided to give up on the jet and wrote it off. In 1982, defense segment earned 10.178 EPS, but there was no commercial aviation losses. So from $1.5 of EPS in 1980s, 2 years later they managed to earn $10.78. Stock followed, and you could have made 4 times your money in only 2 years. This shows that there is a lot of money to be made in turnarounds. Fifth category are cyclicals. Those are companies that their earnings are heavily dependent on market conditions of specific industry. Of course, there's no company that lives in a vacuum and is prone to economy, but some goods are less likely to be bought in a recession. Let's take, for example, dog food. Even if the economy is doing not so well and you need to tighten your belt, you still need to feed your pets. On the other hand, you can postpone changing your vehicle for a year or two as long as it's working. Finally, things deteriorate and you will need to buy another one, so it's sure that rejuvenation will happen. It's just not so obvious when. And this is the whole trick in buying cyclicals and making money out of them. You simply need to time them right. In general, they will lose more market value in a recession, but they will rebound faster than stalwarts. This is where a lot of investors make mistakes, because a lot of cyclicals are well-known big companies, such as Ford, for example. One might assume that a company that big with long history of achievements is a safe bet, but Ford might lose even 80% in recession, just like it happened in the 90s, in the 80s. Typical cyclical industries are automotive, airline, chemical, steel, tires, companies with commodities. And since the world has changed from 1989, I would also add semiconductors to that list. One specific thing to this category is that you might do way better than Wall Street if you are insider. For example, if you are a car salesman, you will have an edge, and that might be all you need. The last category is asset play. This is a company that possesses something valuable, but for some reason, investing community has overlooked that. It might be as simple as pile of cash. For example, net cash per share is greater than price of stock. But with all the screening tools nowadays, probably it would be hard to miss occasion like that. So maybe it would be real estate that you know it's worth more than price of stock. This happened probably less now than it did back then, but it still might happen. Maybe you have an edge, you know that area, and you can safely say that company has something valuable. It happened with Pebble Beach, which had market cap of $25 million in 1976. Main assets of this company was a hotel, two golf courses, 2,700 acres of forest and Monterey Peninsula, and it happened to have a gravel pit. This gravel pit has been sold for 30 million in 1979, which means investors could get paid to own all the other assets. We have 13 signs of a great stock by Peter Lynch. 1. It sounds dull, or even better, ridiculous. Peter Lynch loves companies with names that doesn't sound exciting. Forget Tesla. Look for names like Bob Evans. 2. It does something dull. It's not only name that should be dull. The activity in which company operates shouldn't be that exciting. Peter Lynch gives an example of a company that processes coupons that used to be handed in grocery stores, that enjoyed a terrific run from $4 to 33. It sounds logical to me, as one of my fastest winners in investing career was a company selling suitcases. 3. It does something disagreeable. I think that this might be more important, especially in age of ESG investments. People nowadays are generally more aware of negative health effects of smoking tobacco, but this is where opportunity arises with products that offer more healthy way of consuming tobacco. 4. It's a spin-off. Spin-offs are companies that used to be part of another company, but management decided to take it out as another public company. This might be a great opportunity because parent company doesn't want its spin-off to fail. That would attract bad publicity. Therefore, those companies have strong balance sheets and management that is free to run the company their way. 5. It's not owned by institutions and analysts don't follow it. Maybe the company is too small or insignificant, so it doesn't have professional coverage, but this is where being a small investor comes in handy. Imagine tiny company with few $1 million of market cap and small liquidity. For huge institutions, even buying out a whole company doesn't move the needle. 6. The rumors around it, it's related to mafia or toxic waste. It makes up for one of the perfect stocks for Lynch, waste management. I have never even met a student at business school who said that he wants to start his career in waste management. It's just not exciting, but might be very rewarding. 7. There's something depressing about it. It doesn't have to necessarily mean that company produces something that is harmful, but rather have unpleasant connotations. For example, funeral house is not a place we think about on a daily basis, but might make up for a great investment. It's a no growth industry. And in that case, investing in a great industry doesn't necessarily mean you will get great investment returns. 9. It's got a niche. Peter Lynch refers in that point to another great investor, Warren Buffett, and attributes part of his investing success to investing in a business niche, such as, for example, newspapers. Big newspapers back in the day simply got no competition. But that wasn't the case with Berkshire Hathaway itself, which was textile business selling pretty much commodities. People have to keep buying it. It would come back to the example I gave you earlier on with the pet food. If you decide to adopt a pet, you are responsible to take care of it and feed it, so no matter the situation in economy, you have to buy pet food. It's different with a car, which in most cases you can postpone. 11. It's a user of technology. Lynch says, why would you invest in a company that produces computers when you can invest in a company that benefits from technology, such as ADP? I won't spoil the fun and tell you how good you would do by following this advice. You can do this yourself. 12. The insiders are buying. It's always a good sign that people related to the company buy stock. They know how the company is doing, they know industry, so probably they expect that company is going to do well. 13. Company is buying back its own shares. It's kind of similar with the insiders, but in that case, management decides to use company's funds as they think it's best use of company's capital. It might suggest that company is undervalued, but don't take it for granted. I honestly believe that there's tons of knowledge in Lynch's book, One Up on Wall Street. It's one of the best investing books from one of the greatest investors of all time. And don't be scared about how big his portfolio was. There was a lot of stocks that he simply bought to have sort of tune in later list. You as an individual investor can own as many stocks as you want or as few as you want. Lynch couldn't have more than 5% of his investment funds in one stock, but you don't have the same restrictions. Hope you enjoyed the video, learned something, and please stay tuned for the next video. Goodbye.